Hello student, welcome back to IBS. Today we are going to discuss about performance analysis. First we will try to understand our budget versus static budget and flexible budget and their differences, how to do the variance analysis. Then after we will jump and understand about how actually in company people do the month on month review or quarterly review kind of stuff, like horizontal analysis, vertical analysis, okay, and year to date, how we can actually calculate the variance analysis. Okay, so let us jump to the Excel sheet and understand it in detail. So now we will understand about the flexible budget. Okay, so we have already little bit of discussion regarding this. We'll go deep dive into this. So basically you can see that company has targeted to sold somewhere around 24,000 quantity, okay, of this product. At what rate? You can calculate this simply. This is your total revenue target and this is your quantity. So 120 was the selling price, okay, so there I have updated. So company wanted to sell every product in 120 rupees, okay, and then what is actual price? How will you get actual price? Total revenue divided by total actual quantity sold, so you will get 125. So what is this meaning? Simply we have sold product on the higher cost compared to what we have decided, so this is a good indication. Another point is actual quantity variance. Now we will see. So sales quantity variance, what we will do, we will take actual quantity, we will first give bracket, this is my actual quantity minus standard quantity, then I will apply selling price. What is my selling price? This is 120. So your quantity variance is 4,000, right? Unfavorable. We have planned to sell 24,000, but we have only sold 20,000. So our actual sold product are less than what we have predicted. So that is why that is unfavorable. Okay. We are trying to calculate our quantity variance. So we have reduced standard quantity minus actual quantity, and now we need to multiply by selling price. So this we will get as an quantity variance total. Okay, this is same. Okay, so our quantity variance is unfavorable. Okay, now we want to calculate our selling price variance. Basically we normally always calculate quantity variance and price variances. Okay, so now we will calculate our price variance. What is our selling price? Okay, we'll give bracket, then select selling price minus your actual price and then multiply by actual quantity. Okay, it already written actual quantity. So this is our actual quantity, multiply by actual quantity. So we got 1 lakh as a negative. So what they are trying to say is our selling price was 120 and we sold it 125 rupees per product, which is very good. So we are getting benefit of 5 rupees per product. Okay, and how many product we have sold? We have sold 20 product. So that is why 5 into 20, 1 lakh we have sold in higher price. So this is our price variance is favorable. Okay, though it is by using while using formula it is coming into negative, but you have to understand the concept. Don't go by seeing the minus or positive. Okay, in variance analysis whatever coming into favorable in minus or positive is favorable, no, this will not work. You have to think what formula is. Formula is simply selling price is less than our actual price, so obviously we have benefit because we have sold in higher price, so we charge higher price, so obviously number of quantity how many you have sold, so then you multiply by that higher amount, so you will get the amount. That amount will be always favorable. So if we adjust favorable with unfavorable, we will get total amount. So since this unfavorable is positive and then we are getting either here also positive, so we will consider this as an overall negative sales quantity variance. I hope it is clear to you. If it is not clear, go back and re-watch this video. Okay, now we will move to other point. Okay, now we have actual result. Okay, and this is our flexible budget variance. Okay, now we have flexible budget. So flexible budget has been created based on your actual quantity. Okay, so here you can see this is a static, and we can also create flexible budget. If you want, you can also create here. How we can create? Like this: sales total budget divide by quantity, then multiply by actual quantity, you will get actual sales. So actual sales we have 24, but we sold it in higher side, so that the positive you are getting here. So this is the same thing. Okay, this is flexible budget. So likewise we can also calculate this, but no point of calculating, because unnecessary we will waste a lot of time. Okay, so since it is already been created, you can see flexible budget is coming 100 positive. Okay, and flexible budget it is 202.4 million, as I have calculated just now here. Okay, similarly, likewise we don't need to calculating again and again. Okay, it's just a waste of time. So now we want to know direct material variance. Okay, so I think you have understood this. This is your actual result. This is a flexible budget based on your actual quantity. We have to change our all the expenses and all the expenses and all the calculation we will have to do as per the quantity we sold. And then this is your static budget, and this is your difference between actual and static. Okay, and this is overall difference, like when you consider flexible budget difference and static budget difference, so the average difference you will get here. Okay, so this is the main case, like how we are getting 380 after considering our price variance and quantity variance, then we are getting our actual variance, so that amount is coming here. Okay, so now we will try to calculate direct material variance. So simply for direct material variance, what is the formula? Formula says direct price variance is equal to actual price per unit. So for per unit, what is our actual price? Okay, and price of direct material, because this is direct material variance, don't go by price of sales. Okay, this is direct material. So these are the small point when you are applying formula or something, you have to keep in mind, because this is direct material variance. Okay, so actual price per unit of direct material minus standard price unit of direct material, and then you will multiply by actual quantity purchase. Okay, so how we can calculate? Actual quantity we have already, and standard quantity we already have. So standard direct material we can calculate it. Simply we have our direct material total. Okay, this is our direct material. So direct material cost is 1400 on 440123. Will divide by what thing? Will divide by standard quantity is 24000. So you will get your standard direct material price. So standard price you got. Now we want to calculate actual direct material price. So what is our actual direct material is 1243200. Okay, divide by number of quantities sold. So we have sold only 20,000 quantities. So now we will be getting actual direct material. By seeing it to this, you will be able to identify so whether this is favorable or unfavorable. Actual standard direct material price rate was 60, but we have utilized little bit higher side. So obviously this is negative. Now we want to calculate direct material price variance. There I have calculated. Simply your formula is actual price is 62. You will minus your standard price 60, and then you will multiply by actual quantity. Okay, you can see actual quantity. Okay, so actual quantity you will be having how much? 20,000. Okay, so then you will get $43,200 or INR, whatever it is your unfavorable. Okay, based on static budget. You can see in the flexible budget variance it is saying the same thing. Okay, now we want to know a static budget point of view, how much is the volume variance. Okay, so now our material usage quantity variance also being called as a material usage variance. Okay, material usage variance formula is a standard quantity of material. How much is our total standard quantity? Okay, we use in material, and then minus your actual quantity of material, then you will multiply by your standard price per unit of material. Don't forget about material. So what is our standard quantity? Standard quantity is simply we have 24,000 and we'll minus our actual quantity, so we'll get 4,000 is our total material quantity variance. Then we will multiply by our actual standard price. So what is my actual standard price, which is 16? So if you multiply this, you will get 2,40,000. The same thing will come here, 2,40,000. Okay, this is actually a favorable. Why it is favorable? It is favorable because the material we have planned to use, we have not used that much. We have used lesser quantity or lesser material quantity. So we have targeted to use 14,40,000, or we can say 1.4 million around, and but we have used 12.4 lakh, okay, or 1.24 million. Okay, so that is why this is saying this is favorable. Okay, but in reality, if you try to observe this in deeply, you will see that based on quantity, whatever price, based on total quantity, we are supposed to use only 12 lakhs of material, but we have utilized 12.43 lakhs of material. So somewhere we have utilized more, but a static budget is saying we are in favorable. Why? Because they are considering 24,000, okay, what they have targeted. So based on target quantity, if we sold, then only we are supposed to use this much quantity. Since we have only sold 20,000 of materials, obviously material will also be should be used accordingly, right? So that is why flexible budget come into the picture, and they say no, this is not the right amount. We should have utilized only 12,000. Okay, but the flexible budget will come into the picture, and he will say or 1.2 millions of rupees we have material we have to consume. Since we have consumed higher side, so that is why we are unfavorable. So you can see what exactly the real ground situation is unfavorable, but static budget is saying favorable. So this is the concern. That is why flexible budget has been introduced to so fulfill the gap between your static budget and flexible budget. Okay, now we'll jump to the direct labor budget. Okay, so direct manufacturing labor budget. Okay, this is again, you can see for flexible our cost should be 320, but we have invested higher side, so we are unfavorable. Okay, and what flexible budget is saying? Favorable. Again, flexible budget representing wrong picture. We are going to calculate this. First, we need to have direct labor per unit cost. So how we will get? We can simply already written our total cost. Okay, since we are calculating for a standard direct labor cost. Okay, so we'll apply the standard direct labor cost. Okay, this is the standard direct manufacturing cost. Okay, 3,84,000. Same amount we will divide by 24,000 our total quantity. We'll get the standard direct labor hour rate. So this is our actual standard direct labor rate, and how actually we have consumed okay direct labor, that will be based on the actual amount and divide by actual quantity. You will get actual direct labor rate per hour, whatever the quantity is. Now we will check the variance. So what we will do, actual direct labor, which is somewhere around $19.8 or rupees, and then we'll reduce our standard direct labor price, and then we will multiply by actual quantity as per the formula. So then we will get 76,000, which is unfavorable. Why this is unfavorable? Because as per flexible budget, we are supposed to use or consume only 3,20,000, and but we have utilized 3,96,000, which is higher side. That is why it is unfavorable. Okay, and then if you talk about direct labor quantity point of views, like quantity point of view are normally sales volume. So static budget point of view. Okay, so there what they will do, how much is our standard direct labor hour, okay, which is 24,000, and then what is our actual quantity, and then we will multiply by our standard direct labor hour. As per the rule, you can see standard direct labor hour minus actual direct labor hour, then you have to multiply by standard direct labor hour. So what is our standard direct labor hour, which is 16. So if you multiply this, or you can also write 16, you will get 64,000. You will have the same in static budget, 64,000. What he is saying? Favorable. Why it is saying favorable? If you see this 384, you will minus this 3,20,000. You will get this value. Okay, so between a static budget and flexible budget, the difference is somewhere around 64,000. Okay, so this is called quantity variance or usage variance or static budget variance. All these budget variances between flexible budget and static budget, the difference is coming here. Okay, you can see that 24 lpa minus 28.4 lpa, so difference is 48. So all these differences, difference between flexible budget and static budget. So this is the name of this difference is volume variance, or we can say quantity variance, or we can say usage variance. So don't confuse between usage variance. Okay, you can note it down: quantity variance and volume variance. They have three different names. So in maybe in examination sometimes they ask different way same question, okay, but meaning is same. Now we will try to understand variable manufacturing overhead variance. No variable manufacturing overhead. First we want to calculate variable manufacturing overhead total cost. Will divide by total quantity. What is our quantity? 20,000. We will divide. So similarly, if you divide here, you will get your actual variable manufacturing overhead cost. Okay, so we can say variable overhead cost for manufacturing. For standard, what we will do? We will take a standard price, okay, and then divide by a standard quantity. So what is our, this is your based on static budget, this is your budgeted variable manufacturing overhead cost. You will have to divide by actual quantity, so you will get your standard variable manufacturing overhead cost per unit. Okay, so same rate we got, okay, for variable manufacturing and standard manufacturing overhead cost. So now we have the same formula again: actual variable manufacturing overhead minus standard variable manufacturing overhead, then you have to multiply by actual quantity. So similar, this is actual minus standard, then multiply by quantity. Quantity is 20,000. If you solve this, you will get 21,000. This is unfavorable. Why? Because actual manufacturing cost is higher. This is higher. If it is higher, it means it will give you the negative impact. Okay, that is why it is unfavorable. Okay, if we talk about standard, so this is basically your price variance. Flexible budget versus actual budget variance is nothing, just a price variance. Keep in mind again. Okay, whatever you have this difference, these are all price variance. Okay, you can see this flexible budget variance. So this flexible budget variance is your price variance. Okay, and this variance is always volume variance. You have written over here. Volume variance is quantity variance. So keep in mind, this is price variance, this is quantity variance, but this is called flexible budget variance, and this is called sales volume variance. Okay, also usage variance sometimes, and a difference of these two will be considered as a static budget variance or overall variance. Okay, so price variance we got it. So price variance is your flexible variance. Now we will calculate a static budget variance. So quantity variance. So quantity difference is obviously 4,000 and multiply by your standard price. The standard price is your 12, so you will get 48,000. So that is again your favorable because your quantity is lower. Okay, so since your sold quantity is lower, so that is why your expense would be lower side, so that will be favorable. Where is this? Here you will get. Okay, so a static budget target was 2,88,000, but actually we have consumed 2,40,000 as per flexible budget. So that is why they are saying it is favorable, but the ground reality is we are unfavorable. Okay, so make a note of this kind of thing. So static budget are most of the time they are giving the wrong picture. They are saying we are favorable, but actual result we are not favorable. Okay, now we talk about fixed cost variance. Fixed cost is very simple. Your actual fixed cost. What is your actual fixed cost? This is your actual fixed cost, 5,70,000, and we have, as per flexible, our fixed cost should be 5,52,000 as per the budget. And one more noting point here is static budget and flexible budget have the same fixed cost. Okay, normally don't change, okay, in between flexible and static, because this is fixed. Whether you reduce or increase your quantity of production, it will remain same unless they cross particular certain limit. So that is why this quantity variance or volume variance between flexible and static is always zero. So there you will get the difference is around 18,000 unfavorable because we have consumed more fixed asset cost. Okay, that is why. Now we have clubbed together all our flexible budget variance and static budget variance. Okay, now see this. So if you see this total, if you consider static budget total differences, so you will get the same amount. This is your static budget variance. Okay, if you consider all the revenue to fixed cost, your total variance is somewhere around. Okay, so this is actually contribution margin is also considering all this variance. Consider your revenue variance, material and labor variance, okay, and variable overhead variance. Consolidating all, you will get total variance is 40,000. That will be considered as a contribution margin variance. Okay, in contribution margin, if you will add fixed cost, you will get your total operating income related variance. Okay, so that is your flexible budget variance. You can see this is the same amount coming here, and if you club your static budget total contribution margin and your fixed asset margin, you will get the same amount over here. If you club both of them, you will get a static budget variance. Okay, you can see this static budget variance, this point. Okay, so this is the variance analysis with regard to costing. Okay, and between this is the variance analysis with regards to flexible budget versus actual versus static budget. Okay, so I have explained this to you in very detail. Okay, you can go through this. I will also share this PDF. You can go through this. Okay, I have written this in more precise way. You can also take a screenshot and you can review this also if you want. This is same thing, just written in one particular place. Okay, after calculating all this thing, okay, made it in summarized format. Okay, now we will go to our actual and forecasted. Okay, and then horizontal versus vertical analysis. So based on sales percentage, whatever we are calculating here, the percentage, this is called horizontal analysis. When you are comparing between actual versus budget and the variance you are getting, that is called vertical analysis. So now we have understand about financial statement as well as costing point of view variance analysis. Now we are going to understand horizontal versus analysis, how actually in company we do. So whatever you have performed here, same thing will be executed here. Okay, so you will see that based on what we have done is here, that is this variance analysis is nothing, just a horizontal analysis. Okay, and vertical analysis is based on sales. We have learned in income statement when we are studying about financial statement review. So based on sales, this is your net sales. Based on sales, what is your revenue? So revenue, and there is other revenue. So 2% is your other revenue and 98% is your main revenue. So based on this figure, you are reviewing every other item. Cost of goods is 70%. That is called horizontal analysis. So income statement we do horizontal analysis, and this variance analysis is your vertical analysis. So we have in depth, we have understood. Also we have understood ratio analysis kind of thing. So we have overall understood everything. Now here we will actually put our actual information. Okay, and then we will put our forecasted information, and then we will calculate our variance. Okay, so this we will be learning into the next session. Thank you very much. So again, thanks for watching. See you into the next session.